All right, well, welcome everybody. The time is 12:01 p.m. Today is Tuesday, September 5th, 2023, and I'd like to call to order this meeting of the Finance, Administration, and Procurement Subcommittee for East Bay Community Energy, and I'd like to ask that we begin by having a roll call, please.
Yes, Member Anderson. Member Vidula.
Here.
Member Gonzalez.
Here.
Vice Chair Teresa Cox. Chair Bowers.
Here.
We have a quorum.
Okay, thank you. Now is the time for public comment. A member of the public who wishes to comment on an item not addressed in today's agenda has 2 minutes to do so. Is there any member of the public who is present who wishes to give comment? I see no people at the location and I see no hands raised. Do we receive any written comments in advance of today's meeting for any of the items on this agenda?
We have no written public comment.
No? Okay, so public comment is now closed. I'll turn to item 3, which is the approval of the minutes from the meeting of July 12th, 2023. And recognizing that Director Gonzalez was absent at that meeting, I'll just state for the record that these minutes are a true and accurate reflection of what transpired at that meeting. Oh, there's Member Anderson to help us with that. These minutes are a true and accurate reflection of what happened at that meeting, and I'm happy to take any questions. Are there any comments, corrections, or edits to be made to the minutes of July 12th, 2023? Okay, seeing and hearing none, is there any public comment on the minutes for July 12th, 2023? Seeing and hearing none, is there a motion on the minutes from that meeting?
So moved. Member Anderson.
Second by City Tracy.
Okay, thank you. So I have a motion by Piedmont and a second by Tracy to approve the minutes. Please call the roll.
Member Anderson.
Aye.
Member Vidula.
Yes.
Member Gonzalez.
Abstain.
Cox. Chair Bowers.
Aye.
The minutes are approved.
Thank you. So those are approved. We'll move to our informational items. We have 3 for today. The first is an audit update. It's an informational item on the GASB 62 item as it relates to our audit and the waterfall. And I will turn it over to Jason Bartlett.
Thank you. Good afternoon, everyone. This is an informational item to update the committee on the progress of the audit as well as the status of the GASB 62, of which I will go into detail about what that means. So if we could please go to the next slide, Adrian. So the current state of the audit is, so essentially every year we have an independent fiscal audit performed of our financial statements and processes, as well as controls and related positions. Contractually, we are required to complete this audit no later than 120 business or calendar days after June 30th, which is the last day of our fiscal year. And that usually facilitates presentation of the audit as an informational item in the October board meeting, as we generally get it done in advance of that October 29th deadline. This year, the audit is currently on track to meet all necessary deadlines. We are waiting to see if we can finalize it in time for October board. Next slide, please. So what GASB 62 is it's an accounting mechanism that allows a government agency such as ourselves to defer revenues from one period to then recognize them in another. This is for processes of rate stabilizations to the customers, so that if there are large expenses known to be coming later, revenues can be withheld from being recognized and then recognized at the time that those expenses occur. Traditionally and historically, it was established for bond issuances and holdings like that, but it has become more liberally used to be expanded in that definition. So we originally established this to stabilize against PCIA account imbalances through 2023, and currently it holds about 15.8 million in that deferred revenue situation. We are in the process of developing recommendations for recognizing that revenue and continuing or adjusting this amount based on the the waterfall as it is that was approved for last year's fiscal budget, and the discussion that we're still continuing to have for this current year's fiscal budget. If we could please go to the next slide. So to remind you of what those waterfalls are, in June of last year, the board approved the budget surplus waterfall for the 22-23 budget, which allocates 75 million of net position to be allocated directly to reserves. An additional 50 million on top of that could be withheld for working capital purposes, and then the remaining amount would be split 50-50 between long-term renewable energy development and bill credits that would go to customers. As of today, while we're still performing the audit, so this is a draft estimate, but our current best estimate of change in net position for the fiscal year is going to be around 162 million. So this means that there would be approximately 37 million available for long-term PPA and bill credits. So what we're intending to do, and I think maybe it's on the next slide. Go to the next slide. Right, here it is. So we are considering the options available to us. One, primarily, we are expecting to add 37 million in surplus to the GASB 62 so they could be realized as revenues at the time that these charges occur, particularly with the bill credits that would be given to customers. We expect that to go out in November, and that would be about 18.5 million that we could, because it is based on last year's net position, we would be using it for those bill credits that would go to those customers so that it would not impact the finances of the current fiscal year. Additionally, the equal amount that would be going to PPAs is still being evaluated as to which renewable projects qualify for this, but we are expecting some recognition of that within the next fiscal year. So it is still kind of TBD, but this would be a short-term allocation of 37 million to the GASB 62 fund that we're expecting to resolve within this fiscal year. So I'm not sure if there's another slide after this. No, okay, great. So at this point, I know it's a little, kind of complex accounting, but I can take any questions that the board or public may have.
Thank you, Jason. At this time, I'm going to call first for public comment. Oh, sorry, I'm on delay. I'm going to call for public comment. Any members of the public who wish to comment on this item will have 2 minutes to do so. Are there any hands raised for public comment? I don't see any. Okay, public comment being closed. Are there questions for Jason from members of the committee? Are there comments? Director Gonzalez?
So just, are there limits on how long you can defer the revenue?
Not clearly defined, no. The limit is kind of the practice. So there's no clear definition from GAP or the GASB board on what those are. But the practice, as seen in industry, is that we hold it as long as the liability is present. So, for example, we set the first balance of 15.8 million in 2020 to go through the expected, possible liability of a PCIA balance that we had estimated through 2023. So this December, which is coming up, and so we have not yet. Basically, we've been able to cover those imbalances, so we haven't had to recognize that reserve, that withholding so far. But as long as we're clearly defining what the purpose is of that withholding or deferral, then it's considered to be compliant.
I would just maybe add a little bit more color, which is
sure.
When you speak to our accountant, Mar, who serves as a subject matter expert for us on this, he does give us the guidance that we should recognize that revenue in a short window of time. But as to Jason's point, there's no formal guideline issued by GASB or GAAP to say you must do it within this window. It's more to have some level of certainty and direction on when you will use it, how you will use it, as opposed to just, perpetually defer on it. And obviously, the sooner you do that, the better is sort of our accountant's advice. When pushed on this a little bit, to say like, well, but we want to consider this for a longer term renewables allocation, which could be over the course of, let's say, 10 or 20-year PPA. He has some level of reservation, but has also said there's nothing that explicitly says we can't do that. But that is longer than is historically generally used for in terms of best practices and standard guidance. So it is a little gray, admittedly, from our accountant. I think this is what we've kind of laid out there right now has two important elements. One is that there's this $15.8 million that's existing in there. And I think we anticipate coming back to the board at some time in the near-ish future over the course of the next year to say, this is what we recommend for when to release that if we do not have clear visibility into needing to retain and maintain that GASB account, because that has implications for the waterfall treatment in future years. If we're going to release it, then that release would may go to some certain purpose in the waterfall. And obviously in this past budget cycle, there was some active discussion as to how do we actually want to allocate that waterfall for various purposes. So we wanted to make sure before we go and release that $15.8 million, we had clarity on how to actually run the waterfall and then ensure that we're releasing it in a way that is consistent with that waterfall. So that's one piece. The other piece is that long-term renewables piece, which staff has felt that it's valuable to allocate a strong budget towards long-term incremental renewables as opposed to just buying more short-term renewables. It doesn't really create more renewables in the market. The complication of that is from an accounting standpoint. If you do that for a 10 or 20-year basis, our accountant sort of advises against that. There's no explicit rules that say you can't do that, but generally says advises against that unless we have very good clarity as exactly how we want to do that. And right now there isn't certainty because you have to go out and negotiate a contract, understand what the terms.
Just repeat that last part again. Number two.
Part of the waterfall is it goes through cash, it goes through working capital cash, it goes to reserves, and then it goes to an even split of on-bill credits and an allocation to new incremental long-term renewables. The on-bill credits portion is pretty straightforward. Take that amount of money and you figure out how to allocate that to your customers fairly. You do that on a one-time basis right after the budget, or right after fiscal year's closed out, so your books are closed. The other portion that you put towards long-term renewables, there's a little bit more discretion and uncertainty as to how you apply that. You could do it in a 5-year renewables contract, a 10-year, 15-year, 20-year. What is the price of that renewables? What kind of project that is? There's more discussion that we would want to have with the board to say, this is what we advise. Based off of a recent RFO that we put out in the market for power procurement, we have from the market what are the projects out there. But the projects all come online over the course of the next 5 years or so. And there's various sizes, various prices. And so the intent is to sort of look at a project that you otherwise would not have signed and say, listen, we want to add that project. And we wouldn't have signed because we would say, we didn't like the economics of it. The pricing was a little off. And so this is kind of where we cut it off. We're ultimately going to bring forward, say, 6 projects to the board for approval. Maybe there's a 7th that we otherwise wouldn't have moved forward on. And because we had a strong budget year or a strong fiscal year, we take that surplus that runs to the waterfall, which in this case is about $18 million, and say, we're going to buy that 7, we're going to sign that 7th project that we otherwise would not have signed. And we're going to cover that extra premium there because we have this extra $18 million spread towards it. But that $18 million would be over the course of a, say, 10 or 20-year PPA. So you have that added accounting complexity of we're taking this $18 million and kind of spreading it out for future years. And that's where our accountant says, that's a long time to be applying a GASB account. So we really want to think about whether that's the right usage of that. Alternatively, you could just release the $18 million into your net position, say we had a really strong year, and we just have a more expensive renewables project, and the cost of that gets covered in future years.
More transparent.
But on the topic of transparency, the reason why you consider this, while it may be a little bit more complex to say we're going to go take a GASB account and spread it over, 20-year PPA, is you're taking a strong year and you're covering costs in future years, as opposed to if you release it now, you have a stronger year now, and technically you have a slightly weaker year for 20 years. And if you do this 3-4 times over the course of those future years, you may have some pretty weak years if you have some tight years in general, and then you have 4 projects that were sort of out of the market relative to what you wanted to sign. In future years, you might show a weaker position, and is that an accurate reflection of your future year's financial position? And so that's the question we're trying to think through: is if you're matching up a deferred revenue with those future expenses, is that a better approach? In the same way that you're matching up your on-bill credits that you're releasing in the same period that you're releasing that net position. It's more straightforward when it's so near term and it's so exact. But we're taking the same, methodology and applying it to its long-term renewables. To be clear, we're not asking for formal direction today. This is what we're doing on the current budget, and we will bring this forward for specific action in the future.
Thank you. Are there
That's my question. I'll have a comment later.
Okay. Are there others who have questions? Is that Member Anderson's hand?
Yes, thank you. Way far away here in the distance. So I just wanted to appreciate the COO Chang telling us that the conversation we were just having about this waterfall is really a conversation for the future, and that what's before us today is what the board in 2022 determined would be the waterfall. So this is implementation of what had already been decided. So there'll be more to come, it sounds like, on the waterfall in future years. Thank you.
You're welcome. Okay, I see no other hands raised for questions. At this time, I'd like to have the record reflect that Vice Chair Cox is in the meeting. Welcome, Vice Chair. We are in agenda item number, I believe this is it 4? Yeah, we're in 4. We've just received the audit update, and we've just taken questions, and we're at comment now. So members who wish to give comment on the audit update, informational item only, can raise their hand to speak, and I will recognize them. Member Gonzalez, you had a comment?
Yeah, I think that my comment is pretty simple, that generally we should think about revenue being recognized when the event happens that generates the revenue. We had a sale, we recognize the revenue. If we have surplus, then we should put that into the savings account. We can call it a reserve, we can call it just a cash asset, we can call it lots of things. It's an asset on our books to be used for future investments. But once we start taking cash that happened in 22 and we defer it to 23, 24, 25, 27, and that's after a waterfall to maybe be used for a 30-year investment, I think it becomes much more complicated, less transparent. So I think that that's the general principle. In the case of software revenue recognition, for example, it's tied to the subscription duration. Or for assets that are long-lived, where you're essentially leasing them, it's tied to the length of the lease. It starts really breaking away from that which I'm familiar with, but I want to drive transparency, and transparency usually happens through simplicity. So that's just a general comment as I think through it and look forward to what it is you bring back to us for direction and guidance on.
Okay, I recognize Jason.
Yep, thank you. Just to retort a little bit on that comment, I completely agree. And one of the recommendations that we will be bringing forth, depending upon how circumstances evolve, is the possibility of recognizing those revenues and then putting them into a reserve account for the exact purposes that you've just mentioned. So I do want to comment that we are in.
Can you repeat that last sentence or two? Because you're kind of phasing in and out.
Okay.
Or maybe get closer to your mic or.
Yeah, sometimes if I turn the camera off, the bandwidth is better. I just wanted to note that we are also considering the option of putting those those funds into a reserve account. So recognizing them this year, this is one of the recommendations that we'll be looking at, is recognizing them this year if it's going to be, you know, longer term kind of thing, and possibly putting them into a reserve account that of course will be brought to the board and defined.
Thank you.
Others who have comments on this item? I see no other hands raised. This would be-
Chair,
Oh, Member
sorry.
Bedoya? Yep.
Yes. Actually, I have one question. I definitely sympathize with the comments from Member Gonzalez, Director Gonzalez, but coming at this from a layperson's perspective, is there a tax benefit to pursuing what was just recommended?
So we generally don't pay taxes as a government agency, but there may be some tax implications through PPAs, to which you know, I'm not aware at this time that, you know, that may,
Okay.
if discovered, would definitely come into play.
Okay. Now, if I would just ask from what would be the main benefit for the agency in pursuing that versus, you know, recognizing in current year and doing like a reserves approach?
Sure. So keeping it, the main benefit that that is you know, that we're receiving at this time is that we are not commingling it with current year's revenues, such that would affect the next, like the end of this year's waterfall, which has yet to be decided. So
Maybe put another way is the on-bill credit is maybe an easier, more simple example than the long-term renewables waterfall portion. But for the on-bill credit, we won't actually provide that to our customers until the October to December timeframe of this year, which technically is a different fiscal period than the period in which we actually earn the sort of surplus that we then want to provide back to the customers. So we felt that matching those together in the same time frame has some logic. We're applying that same logic to long-term renewables, where the premium that we're agreeing to pay on those PPAs is going to be over some, you know, future course of time. We're deferring the revenue there similarly to match it in those same periods. There is certainly more complexity there with, you know, say a 10 or 20-year PPA in determining what is that premium price. And so we don't have to take the same approach, but that, you know, with the on-bill credit, I think it's a little bit more straightforward as to why we're doing that.
Okay. And I just want to be clear, I don't have a problem with either approach. Definitely willing to hear both out. Thank you.
Thank you. Are there any others who wish to give comment? Okay, I see none. So we will close agenda item 4. Thank you for that update. We'll move to agenda item 5, which is the Treasury Manager update. It's an informational item only. It's an update on the status of recruiting Treasury managers for the agency.
Thank you again, Director Botters. Yes, so this is an additional information item. Adrian, if we could please move to the next slide. So this is primarily to, we're going to RFP to find a Treasury manager who can manage our unworking capital. So we do hold accounts at River City Bank, which is our primary cash management operator, and we have a credit facility with US Bank, and we have some cash stored there. The cash held at US Bank is approximately 1 month of operating expenses and then held separately for risk management purposes. With this year's contribution, this year being the close of 22-23, our reserves will be, you know, upwards in the neighborhood of 231 million. And we also have a substantial some working capital that, as it retires, it will also require some sort of management and need to be put to work in some capacity. And so this is why we're looking for a Treasury manager, particularly to assist with the responsible fiduciary processes that come with having the surplus of cash. Next slide, please. And so what we're 2 slides back.
We're on slide 3.
You're frozen. It's a few minutes, the computer.
Okay. Okay. Thank you very much, Lisa. So the treasury management services that we're looking for is a kind of systematic management of our reserves and free cash by constructing and maintaining a clearly defined investment plan that can be brought to the board and reviewed and approved. And we're expecting them to also provide this kind of end-to-end service where on the front end, they're going to help us develop the investment policy. They're going to leverage their experience in helping us establish our goals and strategies and building the core foundation for our investment processes. Then they will also provide middle end services where they are actually executing on those goals and that strategy and that base foundation. And then on the back end, full reporting and full transparency on every transaction, every level of interest earned. And of course, the investment policy itself will be compliant with all regulatory codes, state statutes, federal statutes, and of course the goals of our organization. And that includes possible alignment with mission statements as well. So if we go to the next slide, please. So we are conducting an RFP to find a treasury member, so we are this RFP is being managed by a third-party consultant in accordance with the finance team. Selection of the winning bid is expected to be concluded and presented to the board in the November-December timeframe, with expected work to start in January of 2024. And again, this will be the investment policy is expected to be drafted and presented to the board at the same, within that same timeframe of November to December. But of course, after services are selected and approved. So that is an update on our process here and where we are anticipating to have more work to come to FAP and to the board in this area. So hopefully that brings you up to speed with this endeavor. I guess we can take any questions or comments at this time.
Okay, thank you. Could we take the shared screen down, please?
Yes.
Thank you. So now is the time for public comment. Members of the public who wish to comment on item number 5 related to the update on the Treasury Manager will have 2 minutes to do so. Do we have any members present at the Oakland location? I don't see any hands raised, and there are no present members online seeking to be recognized for comment. Comment is now closed, and we'll turn to directors who have questions or comments at this time. This was a brief update on the timeline. I want to thank staff for their work on that. We will see this again in a couple months when it comes back to us for furthering the process. Is there any questions or comments? Member Anderson?
Yes, thank you, Chair. I appreciate that this is coming to us. I think it's a really good idea. I'm curious to know kind of what the approximate compensation model is for Treasury Management Services. I realize we're in an RFP period, so we don't know exactly, but is there kind of a rule of thumb for how the fees are paid for this type of service?
It's the information that I've been getting back on kind of preliminary feelers has been that it's some small margin on top of the returns, or can be some very small margin on the initial balance. So
I think that's certainly part of the intent of the RFP is to understand if
Understand it
there
better.
a
Okay.
fixed fee, is there a time based, or is it purely a small percentage of the balance or the returns? You can imagine we have pretty healthy cash balances, so we're certainly very conscious of a small percentage applied on a large cash balance can still be pretty significant amount of money. So want to make sure that's a competitive offer.
Absolutely. Okay. Thank you.
Okay, are there others who have comments or questions on this item? Okay, seeing none, that will conclude item 5. Thank you so much for that update. And we'll turn to item 6, which is the prepay number 3 summary. So this is a review of energy prepay number 3, the recent transaction closing. As a Courtesy to the directors who were not able to make our last FAC meeting, we spent a considerable amount of time on this item. So this was about an hour to an hour and a half of our discussion was around the preparation work and the recommendations of staff. They gave very detailed answers to how the prepay works. So my ask today is if you have questions about what they just did, that you review that meeting so that we don't need to repeat the entire conversation about how the prepay works. It is all recorded and available to directors to review. But we are going to get an update on the outcome now of the prepay, and I will turn it over to staff to do that.
Great. Thank you. Just a brief memo on this, sharing the very, very positive results that we saw from this third prepay transaction. As a very brief reminder for context, we have brought this forward on a number of occasions to the full board, execcom, and the FAT, as just noted. On July 9th of this year, we brought it forward to the full board for approval to move forward. Shortly thereafter, market conditions were suitable, and so we were able to price the bonds, working with Morgan Stanley as our bond underwriter on August 9th, 2023, so less than a month after that. So we were able to move quickly with our documents and everything that were ready to go. And then we closed the transaction formally just a week after that, on August 16th, 2023. The summary results are listed there. Total bond proceeds were a little over $1 billion. The start date of the energy flows for this 30-year energy prepay transaction are January 1st, 2024, so just in a few months. The tenor of the first bond period is 7 years. We've done a mix of 10 years on the first transaction and 6 years on our second transaction. So this is kind of in the middle. It is in that sweet spot. The cost of issuance was 0.59% on the total proceeds. That's a little bit better than what we've seen in prior cases. We've been able to negotiate those fees down a little bit across the board. And then lastly, perhaps the most interesting number is the average annual savings for this initial term. So each year of the 7 years of this initial period is just shy of $7 million of savings on energy that we were otherwise buying anyways. So that's really just directly accretive to our net position savings to our customers, which is really exciting. The discount equates to about $12.67 per megawatt hour, which is the highest discount that Morgan Stanley has ever priced. So that's I think just a combination of good execution and lucky timing in the market. Obviously, you can't predict interest rates, but you try to be prepared when you see really good interest rate environment. And in this case, we had over 12% savings. Is what this $12.67 per megawatt hour equates to. And on our first transaction, it was about 8%. Our second transaction was about 10%. So being at 12% really is, we continue to see improvement with each of our successive prepays. Though I will be very cautious. I don't want to set an expectation. We'll just continue to get better and better on each of these transactions. They are, conditioned off of how the market is. Together with our first two transactions, so all three of our prepay energy transactions combined equate to about $14 million in annual savings. Again, that's only for that initial bond period, and it will get reset as we go into these future periods. And that equates to about 2% discount on our energy costs. So obviously our energy costs are very significant. And 2% of that at $14 million is certainly meaningful to our customers at the end of the day. I think it touched on the other elements. We did provide a brief just recap of what the board's specific approval was for in terms of parameters. $1 billion in principal amount. I want to be clear, the principal amount for this transaction was a little under $1 billion. The proceeds was a little more than $1 billion. That is normal in a bond underwriting scenario. Your proceeds and your principal are slightly off. And so this was this board parameter was specifically related to principal amount, and we had a minimum savings of $4.50 per megawatt hour. So certainly we exceeded that by a good amount at $12.67 per megawatt hour. I will stop there. I do plan to share this probably as a consent item for the full board, just to share the details. but did want to present it here for discussion.
Thank you very much, Howard. Can we take the share screen up? Thank you so much. All right, now is the time for public comment. A member of the public who wishes to give comment on this item will have 2 minutes to do so. I don't see any hands raised in the Oaken room, and there are no hands raised online. Public comment is now closed. Are there directors who have questions or comments on the report out of the bond sale? I don't see any hands raised online. Director Anderson is recognized.
Thank you so much, Chair. I would just echo what the CEO said and encourage staff to include this for the entire board so they can see the outcome of the action taken previously. Thank you.
Thank you. Director Gonzalez, you're recognized.
So just as a layperson to corporate finance, help me understand how we get $40 extra million.
40 extra, 14.
I see total proceeds 37.2 million, but the principal is only 990 something million.
Total proceeds are over $1 billion,
Sorry, billion. So it's 37 million above the billion in principal. I'm just saying, where does the extra money come from?
Oh, in a bond pricing scenario, you go out to market and you price a principal amount on issuing your bonds, and there's always a slight premium based off of, and I'll admit I'm not a bond underwriting expert, but this is typical that you have your principal and your proceeds amount just slightly off. So in this case,
It's like 4%.
$40 million.
4%.
Yeah,
It's a lot.
yeah,
It's not
and in
little.
other cases, it can be more significant. So, I mean, they're certainly pricing that premium in. To be frank with you, I will get a better explanation from the bond owners for that. But this has
That would be
always
nice.
been the case for when you issue bonds. There's always a difference between your principal and your proceeds amount, and they are very quick to be transparent, of course, on both numbers and why there's a difference. I'll get a better explanation and include that in the consent item.
And then I know we've talked about this both privately and in public at the board meeting. These are zero, there's no recourse. The organization, EBCE, is not in any way obligated with respect to these bonds if there's a non-performance by Morgan Stanley or by anybody involved. We're not on the hook.
That is correct.
Okay, thank you.
Okay, others who have questions or comments on this item, I'll take the time to just thank the staff and the consultants and the other financial partners who helped us put this together. As was mentioned, we had a really was for me, and I think probably, I know, I don't want to speak for Director Anderson, but I know that we had a very informative meeting last time, learning a lot about this, especially as two lawyers, just really trying to understand this, and the staff did a fantastic job outlining how this works. And I think this is a testament to the good work you're doing in procuring, the pre-buy in order to help us save ratepayers money. So I just really appreciate the work you did on this and closing this transaction. This was an informational item, so there are no actions being sought today. There's no additional hands raised for comment. So we will close that item and we'll turn to item 7, committee member and staff announcements or requests for items to be placed on future agendas for this committee. Is there any member here who has a comment that they'd like to give today for any reason that's not for an agenda item? Director Gonzalez?
Yeah, just really quickly, and do we meet every other month? Is that correct?
Yes.
And so will the next meeting have some sort of interim quarterly financial statements?
Be in November.
Great.
Jason, I'm trying to think about timing for each of our quarterly unaudited financials, if that will be time.
Yeah, we're working on unaudited financial statements now. The audited versions will be available well before the next FAP meeting. So those.
Just to be clear, I think Jason's commenting on our audit financials for the fiscal year ending June 30th, 2023. I think you're commenting on other quarters, which I think typically have a 45-day closing process quarter to quarter. So I
yes.
We won't have it probably quite ready for the November FAP because that will only have been 30, a little over 30 days. Typically we want 45 days. And with the posting requirement being a few days shy.
And then the next meeting would be in January.
Yeah, well,
January is only to cover Q1 results.
Yeah.
However, in the regular board meeting, when those unaudited quarterly financial statements are available, we would immediately put it in the consent item for review. So they're available, but we wouldn't have had an opportunity to really review those in detail with the FAT at that stage.
I just from a, the how I think of finance committee meetings, it's the finance committee would see a quarterly financial before it goes to the board stuck on consent. And so if our meetings are misaligned so that our September quarter end isn't considered until January, we might want to think about how we can better align those
What I
dates.
will offer to do, I agree with the request. I agree that quarterlies should come to the committee and be approved before they go to the board to be considered a consent item. I believe that what we did with the composition, there's a significant change in board composition this year. And I know that Chair Marquez worked with the executive director and the executive staff very closely to put together committees. We didn't have any committees operate for a number of months. And when I was asked if I would chair this committee by Chair Marquez for the balance of this year, the schedule that we worked out, given the assignments that were provided to this committee, reflected the availability of people. So what I will commit to, Director Gonzalez, is that in my recommendation to any incoming chair this year is that they, beginning in January, seek and solicit a calendar for the meeting that reflects, as was stated by staff, if they need 45 days delay time after the end of a quarter, that the odd numbered month meetings be structured in a way that it affords the ability for the quarterly update to timely make a committee meeting before it would be recommended to a board meeting. So I will make that recommendation so that after the audit is finished this year, that can be the priority for future meetings in calendar year 24. Would that be acceptable to you?
Thank you. Yes.
You're welcome. Okay, Director Cox.
Good afternoon. I would like to get a update on how we're doing with small and minority businesses and conducting that with East Bay Community Energy contracts and procurement.
Okay, can we request a future agenda item? And if there are questions related to the content of what Director Cox is seeking, can I ask someone from staff, Howard, or one of your team members to follow up with her about what we might provide an update to the informational item to the committee on?
Yes, and if I could just quickly elaborate on that, we typically do an annual supplier diversity report, and I believe that's issued in February. So we could
do what?
Share with you the last report, and then if we would like an interim update, we could do that. Though it is a little bit of legwork to sort of collect all that data because we have to reach out to all of our various vendors and contractors, which is why we do that annually. So if it's okay from a timing perspective, we could wait until February to just issue our next report, which is a pretty robust report.
Yeah, that would be fine. And if we could just show like over the last 2 years or so, like what was set as our baseline and just seeing how we are progressing over the time period to the update in February, that will be fine. So February is the latest update that will meet my needs.
Okay,
great. Thank you. And so with that, just for the purposes of the minutes, I would just like to, Director Cox's request has been approved, and it will come at the normal time that staff provides this report. But given again, the Director Cox is one of the more tenured members of this board, but given so many new people on this board, it would be beneficial if we had the last 2 or 3 years of data provided alongside that, so we can do a baseline comparative as to how our progress is working. Is that an accurate reflection of your request, Vice Chair?
Yes, that is correct. Thank you, Chair.
You're welcome. Any other members who have comments or wish to request a future agenda item for this committee? Okay, I see and hear none. Members, that brings us to item 8, which is adjournment. And I have one request of the clerks. So your minutes are fantastic. They're very detailed, but the one thing that I noticed is missing from minutes is we never actually put the time the meeting is adjourned at the bottom of them. So I would just like to ask going forward that the minutes contain the time that the chair adjourns the meeting for the record, please. And the time for today is 12:46 p.m. The meeting is adjourned. Thank you and have a great week.